Financial Reporting Through the Lens of a Property Casualty Actuary. Part 3, SAP in the U.S., Fundamental Aspects of the Annual Statement. Chapter 10, Notes to Financial Statements. We have now covered the numerical aspects of three of the primary financial statements: the balance sheet, income statement, and statement of capital and surplus. For some of the balances, statutory accounting principles, SAP, requires additional qualitative or quantitative information in order to more fully portray the financial condition of an insurer. The notes to financial statements include some of this additional qualitative and quantitative information. This publication will focus on specific notes that often require direct involvement by actuaries and the notes that are potentially relevant to actuaries. The notes within each of those two categories are described below. Notes often requiring direct involvement by actuaries. Reinsurance, 23. Change in incurred loss and loss adjustment expense, LAE, 25. Premium deficiency reserves, 30. Discounting of liabilities for unpaid loss and LAE, 32. Asbestos environmental reserves, 33. Notes that are potentially relevant to actuaries. Summary of significant accounting policies and going concern. 1. Events subsequent, 22. Intercompany pooling arrangements, 26. Structured settlements, 27. High deductibles, 31. The numbers listed next to each note above are the numbers corresponding to that note in the 2018 Notes to Financial Statements included in the annual statement blank, which are the same as those in 2011. These numbers may change from year to year due to the addition or subtraction of the notes that are required, so these numbers will not be used in the rest of this discussion. Examples will be drawn from the 2018 Notes to Financial Statements for fictitious insurance company, referred to as the 2018 fictitious notes. It is also suggested that the reader review an example of the Notes to Financial Statements from a current insurance company annual statement as they review this section. For each of the notes described, the following information will be provided: information contained in the note, importance of the note to actuaries, example of information from the 2018 fictitious notes. Readers seeking more detail on any notes listed above or on other notes to financial statements can refer to either the NAIC Annual Statement Instructions or the paper notes to the NAIC Property Casualty Annual Statement by Sholem Feldblum and Ralph Blanchard, October 2010. Notes often requiring direct involvement by actuaries. These 5 notes typically require direct input from the actuaries at an insurance company, though in each case the management of the company is ultimately responsible, and in some cases the actuary may be a member of management. Because actuaries will likely be the primary source of input in these cases, readers should review these notes in detail and understand what information is needed to complete them. Reinsurance. The loss and LAE reserve liabilities on the balance sheet and the underwriting income on the income statement are expressed net of reinsurance. Given that reinsurance can significantly lower the loss and LAE reserves on the balance sheet and affect the level of surplus, including disclosures regarding the reinsurance in place are important to assessing the financial health of a company. Actuaries typically estimate the ceded reserves on reinsurance contracts and are therefore directly involved in the preparation of this note. In particular, it is important to understand the potential credit risk associated with the assumed reinsurance recoverables, the risk that the reinsurer will not pay. This note provides information on specific liabilities for which the credit risk may be heightened, such as unsecured recoverables, recoverables in dispute, and recoverables that have been deemed uncollectible. In addition to the assessment of credit risk, there are also some specific accounting rules related to reinsurance that require additional disclosure. The note includes several of these matters, namely the commutation of ceded reinsurance, retroactive reinsurance, reinsurance accounted for as a deposit, and runoff agreements. There are 9 sections of this note labeled A through I. A brief summary is provided on each of these sections. Section A, Unsecured Reinsurance Recoverables. The credit risk related to recoverables with a specific reinsurer is often mitigated by the reinsured having access to a letter of credit, trust agreement, or funds withheld. This note discloses reinsurers for which no such security exists, but only in cases where the recoverable from that reinsurer exceeds 3% of the reporting entity's, i.e., the reinsured's, policyholder surplus. The mention of a reinsurer in this note is not necessarily a problem because those reinsurers may be highly rated and financially sound. The amounts shown for each include paid losses billed but not yet collected, ceded reserves, and ceded unearned premium. Section B, Reinsurance Recoverables in Dispute. Even when a recoverable is secured, it is possible for a reinsurer to dispute or refuse to pay a recoverable. A reinsurer may dispute either because they are unwilling to pay due to a disagreement on the coverage or amount, or because they are unable to pay due to insolvency. A recoverable is considered to be in dispute once a formal written refusal to pay is received from the reinsurer. In addition to identifying a credit risk, recoverables in dispute might represent attempts by a financially troubled insurer to over-recover from reinsurers. Section C, Reinsurance Assumed and Ceded. Although unclear from the vague naming, this section includes information on ceding commissions to reinsurers related to the ceded unearned premium reserve. These ceding commissions received from reinsurers are treated as revenue by the insurer and therefore benefit the insurer's surplus position. This section helps regulators to identify situations where an insurer may be abusing ceding commissions to artificially enhance its surplus position, and it provides information on ceding commissions that would need to be returned in the event of a cancellation. Specific disclosure is also required for contingent ceding commissions. Section D, Uncollectible Reinsurance. If an insurer deems that it is unlikely to collect a specific reinsurance recoverable, it must write off that recoverable as uncollectible and treat it as an expense. This section of the note includes a description of any recoverables that were written off as uncollectible during the course of the year. The disclosures in this note may help an actuary or other user of the financial statements to assess provisions set aside for future uncollectible reinsurance, which is reflected in the provision for reinsurance derived in Schedule F. Section E, Commutation of Ceded Reinsurance. A commutation is a transaction which results in the complete and final settlement and discharge of all, or the commuted portion thereof, present and future obligations between the parties arising out of a reinsurance agreement. This note requires disclosure of any commutations that occurred during the year. This information is important to a user of the financial statements because a commutation may cause a distortion to the income statement and balance sheet because the commutation payment received from the reinsurer may be reflected as a negative paid loss, and the net loss reserves may increase to reflect the elimination of the reinsurance. Section F, Retroactive Reinsurance. Retroactive reinsurance refers to reinsurance that is purchased for liabilities that occurred prior to the effective date of the reinsurance contract. Retroactive reinsurance must be accounted for differently than normal prospective reinsurance to avoid distortion of the balance sheet and income statement. Instead of reducing the net loss reserves, retroactive reinsurance reserves are recorded separately as a write-in item on the balance sheet, with any gain recorded in the income statement and as a restricted special surplus account. This section of the note includes disclosure of any retroactive reinsurance, including reserves transferred, consideration paid or received, paid losses reimbursed or recovered, special surplus generated, and other reinsurers involved in the transaction. This section allows a user of the financial statements to verify that retroactive reinsurance is being accurately accounted for and to understand its impact on the financial statements. Section G. Reinsurance accounted for as a deposit. To be accounted for as reinsurance, a reinsurance contract must meet certain risk transfer criteria. When a reinsurance contract does not qualify for reinsurance accounting, it must be accounted for as a deposit. This means that it is directly accounted for as a deposit asset or liability, depending on if amounts are owed from or to, respectively, other parties under the contract, instead of flowing through underwriting income. If a company has any reinsurance contracts that are accounted for as deposits, a schedule showing the historical changes to the balance since inception of each contract is included. Disclosures for the transfer of property and casualty runoff agreements. Section H. Runoff agreements are reinsurance agreements intended to transfer the risks and benefits of a specific line of business or market segment that is no longer actively marketed by the transferring insurer to a third party. This third party is often another insurance or reinsurance company. If certain criteria are met, a runoff agreement can be accounted for differently than is typically required for retroactive reinsurance. If these criteria are met, the transferring entity records the consideration paid to the assuming entity as a paid loss. If the consideration paid by the transferring entity is less than the loss reserves transferred, the difference is recorded by the ceding entity as a decrease in losses incurred. As noted above, retroactive reinsurance that is not considered a runoff agreement is recorded as a separate item on the balance sheet with no reduction in incurred losses at the time of the transaction. Section I. Certified reinsurer rating downgraded or status subject to revocation. A certified reinsurer is an assuming insurer that has been certified as a reinsurer in the domiciliary state of the ceding insurer and secures its obligations in accordance with the requirements of Appendix A 785, Credit for Reinsurance, of the NAIC Accounting Practices and Procedures Manual. Certified reinsurers that have their ratings reduced or their certified status revoked by the ceding company's state of domicile may have to provide increased collateral. This footnote requires disclosure of the impact on any reporting period in which a certified reinsurer's rating has been downgraded, or its certified reinsurer status is subject to revocation and additional collateral has not been received as of the filing date. In summary, this note is helpful to an actuary or other user of the financial statements because it identifies potential credit risks, sections A, B, D, and I, and identifies types of reinsurance that are subject to specific accounting treatment, sections C, E, F, G, and H. For the sections related to credit risk, A, B, D, and I, the user of the financial statements may ask the following kinds of questions if material balances exist. Section A, unsecured recoverables. Why wasn't security provided? Are there concerns of the financial health of either the reinsurer or the reinsured? Was there a catastrophe that led to a large amount of recoverables? Are all of these unsecured recoverables concentrated with one reinsurer? Section B, recoverables in dispute. What is the point of disagreement with the reinsurer? Is the amount in dispute material to either the reinsured or the reinsurer? Are there legal opinions available on the validity of each side's claim. Section D, uncollectible reinsurance. What was the reason for the uncollectible reinsurance? Could other outstanding recoverables also be uncollectible in the future for the same or similar reasons? How long did it take the company to write off any uncollectible reinsurance that was disclosed? Section I, certified reinsurer rating downgrade or status subject to revocation. What was the reason for the downgrade or revocation? Why wasn't the additional collateral provided as of the filing date? The disclosures in this note are of specific interest to an actuary who is opining on a company's loss reserves, because several of these items are referred to explicitly in the Statement of Actuarial Opinion, SAO. A review of the 2018 fictitious notes indicates that fictitious provided disclosures related to unsecured reinsurance, commissions, and retroactive reinsurance. The other items were not applicable for the 2018 year. Change in incurred loss and loss adjustment expense. The total incurred loss and LAE for a year can be thought of in two categories. 1. Loss and LAE that were incurred on liabilities occurring during the current accident year. And 2. Any changes in incurred loss and LAE from previous accident years. This note relates only to the second of these two terms. The content of this note should include the amount of the change, i.e., reserve strengthening or weakening, in liabilities for previous accident years, the segments or lines of business that led to that change, and the reason for the change. The importance of this note to the financial health of an insurance company is twofold. First, the existence of a material change in prior accident years' incurred losses in LAE affects the current year's underwriting income and could obscure the true underlying experience of the current in-force business. A company that achieved positive underwriting income solely as a result of decreases to prior year's loss and LAE estimates may have profitability issues on their current business. Second, recurring material changes in prior accident year incurred loss and LAE may be indicative of a bias or problem with a company's reserving process. For instance, if a company consistently experiences significant decreases in their estimates of prior accident years' losses, then there may be inherent conservatism to the company's process for establishing loss and LAE reserves. Schedule P provides additional information that may assist in this assessment, and it will be discussed in more detail in Chapter 15, Schedule P. Actuaries should be familiar with the required content of this note so that they are prepared to provide input to management. Also, when reviewing a company's financial statements, actuaries may be in the best position to identify one of the two problems noted above. This note should be consistent with information included in a similar note to the annual Generally Accepted Accounting Principles financial statements, and also to the one-year development column from Schedule P, Part 2, with the exception of adjusting and other loss adjustment expenses, which are included in this note, but not in Schedule P, Part 2. Finally, if the actuary is the appointed actuary for the company, the actuary may be called on to understand the difference in estimates underlying the loss reserves, since the prior year's estimates, and comment on those changes in the appointed actuary's Statement of Actuarial Opinion. For that reason, the actuary needs to be aware of the content of this note. In the case of the 2018 fictitious notes, it is disclosed that the prior year-end total loss and LAE reserves developed favorably by $875,000, and several specific segments were cited as the major drivers of this favorable development. According to Fictitious's income statement, the company's net income in 2018 was $2.2 million. This tells the user of the financial statements that the favorable reserve development was a significant factor in the financial results of the company for the year. Chapter 12, 5-Year Historical Data Exhibit, will provide guidance on how to assess whether this favorable development has been occurring consistently over time. Premium Deficiency Reserves. Premium deficiency reserves must be recorded when the unearned premium of in-force business is not sufficient to cover the losses, LAE, and maintenance expenses that will arise as that premium is earned. Companies have the option to consider investment income when performing this calculation. Also, before performing the calculation, the business should be grouped in a manner that is consistent with how it is marketed, serviced, and measured. Most insurance policies sold by insurance companies are priced with rates that are greater than the expected losses and expenses, especially after consideration of investment income. Furthermore, if there is a segment of the business that is underpriced, it may be a part of a larger grouping where the deficiency in that segment is offset by other more profitable segments. For these reasons, the premium deficiency reserve will be zero for a majority of companies. However, there are cases where a non-zero premium deficiency reserve exists due to regulatory, competitive, or other conditions that led to inadequate rates. When a non-zero premium deficiency reserve does exist, a company may record it as either a write-in liability or a part of the unearned premium reserve on the balance sheet. When it is recorded as a part of the total unearned premium reserve liability, the notes to financial statements is the only way to identify whether a premium deficiency reserve exists and the amount of the reserve. In the note relating to premium deficiency reserves, the company must disclose the amount of the premium deficiency reserve. The company also needs to disclose whether investment income was considered in the determination of the premium deficiency reserve, although this is often disclosed in the accounting policy note. This note is relevant to users of the financial statements because the existence of a premium deficiency reserve is usually a clear indication that issues of rate adequacy exist for at least the affected segment. However, the absence of a non-zero premium deficiency reserve does not necessarily indicate that rates for all business segments are adequate, due to the ability to consider investment income and to group segments into broad categories. As a result of actuaries' involvement in the pricing and reserving of business, actuaries are in a position to provide input on whether a premium deficiency reserve is necessary and on the amount of the premium deficiency reserve. The analytical approach for this is beyond the scope of this publication, but there are other resources available that provide direction. In the 2018 fictitious notes, the note on premium deficiency reserves indicates that at December 31st, 2018, the company had liabilities of $0 related to premium deficiency reserves, and anticipated investment income was considered in that determination. If an insurer were to elect to change its consideration of investment income from one year to the next for the purposes of calculating the premium deficiency reserve, that change would likely need to be disclosed, along with the amount of the impact, in the note called Accounting Changes and Correction of Errors. Discounting of liabilities for unpaid loss and loss adjustment expenses. This note indicates whether a company discounts loss reserves, and if so, it also describes the basis for calculating the amount of the discount. There are two types of discounting that need to be disclosed: tabular discounting and non-tabular discounting. Tabular discounting applies specifically to outstanding annuity-type claims that pay pension benefits. These claims arise most commonly from workers' compensation coverage, but may also arise from other types of liability coverage. A tabular discount reflects mortality assumptions according to a specific life table and a defined interest rate. Both the life table and the interest rates may be specified by the state regulator. Not all insurance companies that have these eligible liabilities choose to use tabular discounts. In the first part of this note, the company needs to indicate whether any liabilities are discounted using tabular discounting. If any tabular discounting is used, the company also needs to indicate the basis and assumptions used in calculating that tabular discount. For instance, in the 2018 fictitious notes, the company disclosed that tabular workers' compensation case reserves were discounted under various state laws, reflected a discount rate of 3.5%, or a rate prescribed by the state regulator, and were derived based on a defined set of U.S. life tables. In the second part of this note, any non-tabular discounting needs to be disclosed and described. This should reconcile to the amount of the non-tabular discount that was disclosed in Schedule P, Part 1, columns 32 and 33. Non-tabular discounting is less common than tabular discounting, and is typically only done in specific cases where a company has been permitted by its state regulator to discount a specific type of liability. Two lines of business most commonly used for non-tabular discounting are workers' compensation and medical professional liability. While tabular discounts are calculated for specific pension claims, non-tabular discounts are typically calculated on the aggregate amount of a specific segment of reserves by using a projected payment pattern and an assumed discount rate. If a company applies any non-tabular discounting, they must disclose that and describe the basis in this note. We can see from the 2018 fictitious notes that the company did not apply non-tabular discounting. The note also requires a company to disclose whether any of the key assumptions used to discount loss reserves, whether for tabular or non-tabular discounting, have changed relative to the prior year. It is important for actuaries and other users of the financial statement to be familiar with this note, because different companies have different discounting policies, and those differences must be considered to make a consistent comparison. Non-tabular discounts may be of particular interest because they usually exist due to a specific exception granted by the regulator, which may relate to the solvency of an insurer. Furthermore, an actuary that is opining on the loss reserves of a company must disclose and describe any discounting of loss reserves in the SAO. Asbestos and environmental reserves. Asbestos and environmental liability reserves have developed adversely over the past several decades. Therefore, exposure to asbestos or environmental liabilities can represent a significant source of uncertainty in a company's loss and LAE reserves. Furthermore, asbestos and environmental liabilities have consistently developed adversely over the past several decades. For these reasons, specific qualitative and quantitative disclosure is required regarding a company's asbestos and environmental reserves. This note requires a company to disclose whether it has identified a potential exposure to asbestos or environmental reserves. These disclosures specifically exclude exposures relating to policies that were issued specifically to cover asbestos and environmental exposure. If the company answers affirmatively for either asbestos or environmental exposures, it must disclose the lines of business affected, the nature of the exposures, and the reserving methodology used to estimate the liability. In addition to those qualitative disclosures, the company must complete a table that provides the following information for each of the past 5 years: beginning reserves, including case, bulk plus IBNR loss and LAE, incurred loss and LAE, calendar year payments for losses and LAE, and ending reserves, including case, bulk plus IBNR loss and LAE. This information must be provided separately for asbestos and environmental reserves on a direct, assumed, and net of reinsurance basis. The company must also disclose the amount of the reserves that relate to unreported claims, i.e., pure IBNR. This note is important to the users of the financial statements because it discloses the existence of asbestos and environmental exposure, the magnitude of that exposure, and the recent development of that exposure. In cases where these liabilities are material relative to a company's overall reserves and/or have consistently been developing adversely, it should serve as a potential warning sign to the financial health of the company. Actuaries at insurance companies are often directly involved in the estimation, monitoring, and reporting of asbestos and environmental reserves. In situations where the financial statements of a company are under financial review, actuaries may also be in the best position to evaluate the disclosures made here for potential impact on the financial health of the company. In the 2018 fictitious notes, the company acknowledged exposure related to asbestos and environmental liabilities. The company then described its process for identifying, monitoring, and estimating these exposures. The excerpt below in Table 6 shows an example of the 5-year history of the calendar year incurred and paid asbestos losses and LAE on a net of reinsurance basis for fictitious. In this case, we see that the net asbestos liability as of December 31, 2018 was $3.28 million. We also see that there was adverse development in fictitious's asbestos reserves from 2015 through 2018, as evidenced by the incurred losses and LAE each year. The excerpt below in Table 7 includes the information on the proportion of these reserves that relates to unreported claims. From Tables 6 and 7, we see that $2.78 million out of the total $3.28 million in asbestos reserves, or 85%, related to unreported claims. The majority of the liability that is related to unreported claims underscores the high level of uncertainty in these liabilities. Notes that may be potentially relevant to actuaries. In addition to the 5 notes described above, there are several other notes that may be potentially relevant to actuaries. Actuaries should be familiar with these notes and their significance, and they may need to review them when they are evaluating the reserves for a company, particularly if they are the opining actuary. Summary of significant accounting policies and going concern. This note describes the accounting rules used to produce the annual statement, including the source of the accounting rules, typically the NAIC Accounting Practices and Procedures Manual, any exceptions that were made in applying those rules, and the basis for those exceptions, such as an exception that made with specific state approval. Additional detail on the company's significant accounting policies. Where exceptions are made to the rules in the NAIC Accounting Practices and Procedures Manual, they must be either prescribed or permitted by the domiciliary state. Prescribed refers to practices that are required by state law, and permitted refers to approval by the state regulator. An actuary who is evaluating the reserves of a company will want to review this note to identify prescribed or permitted practices or other accounting policies that relate to loss reserves. Any unexpected deviations described in this note should be evaluated for their impact on the reserves and general financial health of the insurance company. The following provides an excerpt of this note as provided in the 2018 annual statement for fictitious. 1. Summary of significant accounting policies and going concern. A. Fictitious insurance company prepares its statutory financial statements in conformity with accounting practices prescribed or permitted by the state of Florida. The state of Florida requires that insurance companies domiciled in Florida prepare their statutory basis financial statements in accordance with the National Association of Insurance Commissioners, NAIC, Accounting Practices and Procedures Manual, subject to any deviations prescribed or permitted by the Florida Insurance Commissioner. The impact of any permitted accounting practices on policyholder surplus of the company is not material. As shown in this excerpt, the company prepared its statutory financial statements in conformity with the practices described or permitted by the state of Florida and with the NAIC Accounting Practices and Procedures Manual, subject to deviations prescribed or permitted by the Florida Insurance Commissioner. Further, the note indicates that the impact of any permitted practices on policyholder surplus was not material. Events subsequent. Subsequent events are broadly defined as events that occur between the date of the financial statements, for instance, December 31, and the date that the financial statements are issued, for instance, March 1. Within the broad category of subsequent events, there are also two specific types that should be recognized. Type 1, recognized subsequent events. Subsequent events provide additional evidence with respect to conditions that existed as of the date of the balance sheet. An example of this type of information would be if updated information was received on a large claim on January 15, when that claim had already been reported and known of prior to December 31, and the company deemed that insufficient IBNR was carried to cover the additional needed reserve. Type 2, non-recognized subsequent events. Subsequent events provide evidence with respect to conditions that did not exist at the time of the balance sheet. An example of a Type 2 subsequent event would be if a new large claim occurred on January 15 and was not previously known. Type 1 subsequent events should already be reflected in the recorded amounts of the financial statements, because the financial statements should reflect all information that is known up until the day that the financial statements are issued, relating to the conditions that existed as of the counting date. Disclosure is not needed unless it is, quote, necessary to keep the financial statements from being misleading, end quote. For example, if the booked reserves could not be adjusted in time to incorporate the revised reserve amount necessary to reflect the Type 1 event, this note would disclose the amount by which the reserves need to be adjusted. Note that changes that are made to reserves due to their normal continual review are not considered Type 1 events. Type 2 subsequent events are not already and should not be reflected in the financial statement. However, they should be described in this note if they, quote, may have a material effect on the financial condition of the company, end quote. The guidance says, quote, may have, end quote, which means that even if a company has determined that the impact is not material, it should still be disclosed as long as it may have a material impact. Type 2 subsequent event disclosure, of course, requires use of management's judgment. An actuary or other user of the financial statement may consider reviewing this note to verify whether there are any material subsequent events that are not reflected in the financial statements. This is of specific importance to an actuary that is opining on a company's loss reserves, because the opining actuary will need to determine whether a subsequent event is material to the estimate of the loss reserves and whether that subsequent event should be considered. Review of the 2018 fictitious notes indicates that no subsequent events were disclosed. Intercompany pooling arrangements. Intercompany pooling is a common arrangement among companies in a group in which each of the participants fully cedes all of its business to the pool leader, and then each participant assumes back a specific percentage of the total. In these situations, it is important for a regulator or any other user of the financial statements to understand the pooling arrangement to assess the solvency of the group as a whole. This note discloses the existence of the pooling arrangement and also describes the cessions and assumptions that occur. Typically, this includes identification of each company in the group, the lead company, and the pooling percentages for each participant. In cases where pooling exists, it will affect the various aspects of the annual statement in different ways. Some examples include the following. The underwriting and investment exhibit will show direct business written by each company and the amounts ceded to the lead company in the pool, and the portion of the pool assumed specifically by affiliates. Schedule F will show the cessions to the lead company as ceded reinsurance in Part 3 and the assumed business in Part 1. Schedule P will show only the pool members' share of the pooled results. The 2018 fictitious notes indicate that this company did not participate in any intercompany pooling. Structured settlements. A structured settlement refers to a situation where an insurance company settles a claim by purchasing an annuity on behalf of a claimant. This is most commonly observed on workers' compensation or general liability claims, and the annuity is usually purchased from a life insurance company. When the annuity is purchased, and the claimant is the payee, it is recorded as a paid loss by the original insurance company, and the claim is considered to be closed. However, if the life insurance company providing the annuity was ever to become insolvent, it is possible that the original insurer could still be liable for the remaining portion of the annuity payments. The purpose of this note is to disclose the total amount of structured settlement payments for which an insurer could be held liable. Furthermore, if the amount of these remaining payments from a single life insurance company exceeds 1% of surplus, specific disclosure of the amount and the company from which the structured settlement was purchased is required. This note is relevant to users of the financial statements because it describes a potential liability or credit risk that is not reflected on the balance sheet. The identification of life insurers that provide coverage for remaining payments exceeding 1% of surplus allows for further review of their financial condition to identify any significant issues. Review of this note in the 2018 fictitious notes indicates that in total the company purchased structured settlements with a statement value of $4.3 million. High deductibles. High deductible policies are commercial insurance policies that have a significant deductible, such as $250,000, giving the insured a substantial retention on each claim. Under these high deductible policies, the insurer pays the full amount of the claim and then seeks reimbursement from the insured for the portion within the deductible. These types of policies are most commonly seen in workers' compensation, but also may be used for liability business. Similar to the situation with structured settlements, these policies can present a credit risk to the insurer that is not apparent in the financial statements. For unpaid claims, the portion of the unpaid amount within the deductible is not included within the insurance company's booked loss reserve in the annual statement. The treatment for both paid and unpaid deductible losses creates a credit risk for the insurer due to the possibility that the insured will not reimburse them for the deductible portion of the loss. This note requires disclosure of the following: the amount of reserve credit, i.e., the amount of case reserves established for the deductible portion of a loss, recorded by the company for unpaid claims. The amount of billed but not yet collected deductible reimbursements for paid claims. To understand the potential impact of this credit risk, an actuary or other user of the financial statements who is reviewing the financial health of a company can consider the total amount of credit risk relative to the total unpaid claims and to the company's surplus. As noted in the notes to financial statements for Fictitious does not issue any policies with high deductible plans. Summary. Notes to financial statements provide additional qualitative and quantitative disclosure to support the numerical information provided in the statutory financial statements. The notes provide additional detail to assist the user of the financial statement in understanding the numerical exhibits and provide a source of publicly available information on off-balance sheet items.